Hello and welcome to our bi-weekly Understanding Markets video update. We're recording this on the afternoon of Tuesday, the 3rd of May. I'm Hellen Dalton, a Senior Investment Manager here at Cantor Fitzgerald. And today I'm joined by Pearse MacManus, the Chief Investment Officer of our institutional arm, Merrion Investment Managers. Thanks for joining us, Pearse. We've just had the April month end. So how did markets fare?
Thanks, Helen. Yeah, it was a bad month and a bad finish for all asset classes. US 10-years risen up to 3% yields, which is up about 20 basis points on the week. The Nasdaq was down 4% last week, which is down 13% for April, and the S&P was down 3% last week and down 9% for April. Europe it performed a lot better. It was still negative over the week and on the month, but it certainly feels like this latest bout of selling is a US-centric sell-off, driven by US inflation, concerns about that, the strong dollar, and a hawkish Fed. There is a lot going on globally. Markets have been pricing in for the bulk of this year ever-increasing hawkishness from central banks, except in China, where it appears the authorities are relaxing some of the restrictions on big tech and trying to stimulate the economy, but that's to counteract the rolling lockdowns.
Earnings season is in full swing now. The likes of Netflix has grabbed the headlines, as it were. Is that the full story?
Yeah, we're well through earnings season, and generally it was reassuring. I mean, 80% of companies in the US beat on earnings, and that's despite 3 to 4% headwinds because of the dollar. So except for those stay-at-home beneficiaries such as Netflix, and they kind of messed up on passwords and didn't give a very reassuring outlook, and Amazon overinvested, but results were very good for the likes of Apple, Visa, Microsoft, Qualcomm. So it was quite reassuring, and 80% of companies beating on earnings is quite impressive.
That does indeed sound very positive. And has it helped sentiment at all?
Yeah, you would think so, but despite that, sentiment is extremely sour. This has been driven by central bank hawkishness, fear about inflation, fears about growth, fears that the Fed is just going to keep hiking interest rates until something breaks.
And of course, inflation is the topic we keep coming back to in these updates. What's the current view?
Yeah, inflation data over the last couple of weeks does suggest that we're past the peak of inflation. I mean, core CPI in the US was a little bit weaker than expected. Don't want to latch on to 1 month or anything, but the Dallas Fed trimmed mean inflation, which sort of takes out all the outliers. That has slowed a little bit. Used car prices seem to be coming off. In addition, we had a very weak Q1 GDP print in the US. It was actually negative, driven by net exports. And the ISM yesterday showed that growth was slowing and prices paid were slowing. But despite this, the market has moved just to continually price in more and more rate hikes from the Federal Reserve and also from the ECB over the last month, and at an even faster pace, with 12, 13 rate hikes priced in by year end. And that, of course, has seen yields rise very rapidly and credit spreads widen. So there's that fear coming into the market now that the Fed is going to keep going, as I said, till something breaks. So to an extent, the market has kind of done the Fed's tightening for it. I mean, the Federal Reserve was loosening policy up until last month. They were still buying bonds, and they've only raised rates once. So, but the market has done an awful lot of tightening for them through widening of credit spreads, increasing short-term interest rates, and 2-year bond yields. And the Fed needs to do a bit of catching up then.
That's actually very interesting, because this has been happening over the last week or so, and we haven't even heard from the Fed because they're in a self-imposed blackout. Is that right?
Yeah, they have That's right. They have a self-imposed blackout ahead of their meeting where they don't speak at all. And one might have expected, given that every time they've spoken this year, it's ratcheted on another couple of rate hikes in market pricing. But, this week's FOMC meeting tomorrow, it'll be very important in that regard, because, the market, as I said, has priced in ever-increasing hawkishness from the Fed. Growth expectations are falling very rapidly. There is that significant concern that the Fed will just push it too far, even though they've only started, but the market has done quite a lot of tightening for them. So it'll be important for the Fed to get that message across that it's not their intention to break the economy, to cause a recession. I don't think the Fed really wants to engineer a recession. They're obviously under significant pressure to make some attempt to bring the inflation rates down, but the evidence, as I said, is mounting that the year-on-year inflation rate should start to dissipate over the coming months.
So that's the Fed, and of course we'll hear from them later in the week. What about the ECB?
Yeah, the ECB is a long way behind the Fed. I mean, the Federal Reserve has already hiked rates, and earlier in the year, the market was pricing in the possibility of a rate hike in December from the ECB, and that was the messaging that was being given by this ECB President Lagarde. And then now the market moved to price in a September hike and has now moved to price in a July hike, which is pretty much just after the next meeting. We don't really hear from them again in terms of official meetings until June. But again, the market is pricing in a July liftoff for the ECB, and 10-year bund yields, for example, hit 1% this morning.
Wow. Okay, that is quite a different stance from what we've been hearing so far. And where does all of that leave our clients?
Yeah, well, the markets are pricing in a really hawkish Fed and a relatively hawkish ECB and quite negative outcomes. And sentiment is very poor. Equity selling has been really extreme and intense, even as that evidence mounts that, the central banks may not need to do everything that the market has priced in. That might meet in the middle somewhere, particularly if inflation starts to dissipate from here. And, if ECBs don't need to be as hawkish as the market currently fears, then the economic expansion can continue. Everything can calm down a little bit. And, if we look at, say, earnings, as I said, Q2 earnings or Q1 earnings season was very strong, but the market has priced in a significant reduction in earnings going forward. And if we can, get through this, then I think the outlook is very positive on a medium-term view for equities.
Many thanks, Pearse. It's always great to hear from our institutional colleagues, and I know that our clients really appreciate it. Many thanks for your time. Our next update will be on the 18th of May. Please do get in touch with your Cantor Fitzgerald broker if you have any questions in the meantime, and we will see you again in 2 weeks.